All right, everybody, welcome back to the Deep Dive, where we like to do exactly that, dive deep into some of these complex earnings calls and financial reports so you don't have to.
Yeah, we really try to extract, the insights that are important for experienced investors like yourselves.
Exactly. And today we are diving into Signet Jewelers, fourth quarter fiscal year 2025 earnings call.
Yeah, looking at a company that's been around for a long time, really sort of trying to navigate, I think, a changing retail landscape and, kind of a changing consumer.
Definitely a lot going on with this company.
Okay.
So let's just get right into the core numbers. For the quarter, Signet reported revenue of $1 billion.
Okay.
Now, while that is a 6% decrease year over year, it's important to note that they actually exceeded their own updated guidance.
Yeah, interesting. So they actually did a little bit better than they thought they were going to do.
Yeah, so that's always good news, right?
Yeah.
And then when we look at same-store sales, they were down by 1.1%.
Right.
But here's a key point to keep in mind. Last year had an extra week, which accounts for roughly a 4 percentage point difference in that comparison.
So it's not as bad as it looks on the surface.
Exactly.
Yeah.
So while the headline might suggest, a dip factoring in that extra week, paints a slightly different picture. Now, what's particularly interesting, though, is what happened beneath that top-line figure. We saw some real movement in the average selling price of their merchandise.
Okay, so they're selling maybe less things, but at a higher price.
Yeah, exactly. So their merchandise average unit retail, or AUR, think of that as, the average price their product sold for saw a significant 7% jump.
Okay.
So digging into the details, bridal AUR was up by 2%, which is their best performance in that segment in 2 years.
Oh, wow.
But the real standout was fashion jewelry, where AUR climbed by a notable 8%.
Wow, okay.
Interestingly, they mentioned this was partly due to some of their lower price gifting options not performing as well as anticipated during the holiday season.
Okay, so maybe a little bit of a miscalculation there in what consumers were looking for.
Potentially, yeah. We'll have to see how that plays out in the future. Turning to profitability, their adjusted gross margin was $1 billion, or 42.6% of sales.
Okay.
That's a decrease of 70 basis points compared to the previous year.
Right.
The primary reasons they cited were fixed cost deleverage and some year-end adjustments within their digital brands.
Okay. And so fixed cost deleverage, just for, people at home, what does that actually mean?
Yeah. So when we talk about fixed cost deleverage, what does that really mean in this context?
Well, I think the simplest way to think about it is your fixed costs, like rent and salaries.
Yeah.
Those things are going to stay the same regardless of how you're doing. But when your sales go down, those fixed costs then represent a larger proportion of your total cost structure.
Exactly.
And it squeezes the margins.
That makes sense. All right, on the expense side, adjusted SG&A, that's selling general and administrative expenses, came in at $638 million.
Right.
Which was actually down by $32 million year over year.
Interesting.
However, as a percentage of sales, SG&A increased slightly by 30 basis points to 27.1%.
So they cut some expenses, but because the revenue fell by a larger percentage, those expenses still represent a bigger part of the business.
Yeah, exactly. Their adjusted operating income for the quarter was $356 million. While that exceeded their updated expectations, it was still lower than the same period last year.
Okay.
Looking at earnings per share, adjusted EPS was $6.62, which was almost identical to the previous year.
Okay.
And a key factor here was a significant reduction in their outstanding share count.
Oh, that's interesting. So share buybacks really having a big impact there.
Yeah, huge impact on that number.
Yeah.
Let's take a quick look at the balance sheet. Inventory at the end of the year stood at $1.9 billion, roughly the same as the year before, and they mentioned introducing new styles.
Okay.
Capital expenditures for the year totaled $153 million.
So keeping that inventory level stable, but bringing in fresh designs, that suggests a pretty disciplined approach, I would say.
Yeah.
And the CapEx figure is likely, reflecting those investments that they're making in their stores and in technology.
Yeah. For the full fiscal year 2025, their free cash flow was a robust $438 million, representing a healthy 88% conversion of their adjusted operating income into cash.
Okay.
And then they also made some significant moves to return capital to shareholders, buying back approximately $1 billion worth of their stock.
Wow.
Which led to a nearly 20% reduction in their diluted share count.
Yeah, that's massive. I mean, that's a big reduction in shares, and that's going to boost those per share metrics.
Exactly. So clearly a commitment to those shareholders.
Yeah.
And on top of that, They've increased their quarterly dividend by 10% to 32 cents per share, marking their fourth consecutive annual dividend hike.
Okay, so they're giving back to the shareholders in multiple ways.
Absolutely, yeah. And they finished the year with a strong liquidity position of $1.7 billion.
Yeah.
And looking ahead, their first quarter to date is showing positive comparable store sales.
Okay, that's good to hear, because it seems like they have a good amount of cash.
Yeah.
And they're also, doing well in the beginning of this quarter. That's a positive sign after maybe a little bit of a challenging previous quarter.
Absolutely. So we've got the financial snapshot now. Let's dig into the more strategic aspects of this call.
Yeah, the fun stuff.
Right. A major shift that they're emphasizing is moving away from managing their business with a primary focus on individual store banners.
Okay.
Like Kay or Zales.
Right.
And instead, building stronger, more distinct individual brand identities.
Okay.
To foster deeper customer loyalty. They estimate that even a relatively small 5 percentage point increase in how often consumers consider their brands could translate to around $500 million in additional revenue.
Wow, that's significant. So why this move away from, the banners to these brands? What do they think is going to be the benefit there?
Well, why is this brand-centric approach so important?
I think the idea is to try and, create a connection with the consumer.
Right.
Right. And if you have just kind of this broad, overarching marketing approach, you're not really speaking to anyone in particular.
Right.
But if you can, speak to the specific needs and desires of a specific customer base through the branding,
right,
you're going to get a much better response. You're going to get much more loyalty.
Yeah, you're going to create those fans.
Exactly. And potentially even reduce the reliance on discounting because you're giving people what they want.
You're creating that brand value.
Exactly.
Absolutely. And this feeds directly into their go-to-market modernization strategy. So this isn't just about a new logo.
It's about really clarifying what each brand stands for to attract specific customer groups. They're focusing heavily on style and bringing fresh products to market faster through their own in-house design teams and strategic collaborations. A prime example being the partnership with Blue Nile under the Jared banner.
Interesting.
They're also looking at how they present themselves to consumers, from the layout and feel of their physical stores to the storytelling they use in their online presence.
So really thinking about that customer journey and that customer experience in a new way.
Exactly. And in today's retail environment, that's absolutely crucial. Consumers expect that seamless, engaging journey.
Right. It's not enough to just have a great product. You have to have a great brand.
Exactly.
And a great experience as well.
Absolutely. Their second key pillar is core business growth and adjacent opportunities. They're obviously looking to maintain and grow their share in their traditional strongholds, bridal and gold jewelry. But they're also strategically targeting adjacent markets, specifically the self-purchase and gifting segments within the massive $50 billion fashion jewelry market where they currently hold a mid-single-digit market share.
Okay.
They made a significant point that gaining just a 1% share in that fashion market would actually have a bigger impact on their revenue than a 1% gain in the bridal market.
Wow. So why is that?
What does that tell you?
I mean, to me, what that suggests is the fashion jewelry market is just so huge.
Yeah.
And even though bridal is obviously a big part of their business, the frequency with which people are going to buy, fashion jewelry for themselves or for gifts,
right,
that's just a much larger market.
Exactly.
And also they have a much smaller market share in the fashion category, so there's more room to grow.
Yeah, exactly. To enable all of this, they're undertaking a significant operating model redesign. This isn't just tinkering around the edges. They're talking about fundamental changes to simplify their structure, drive efficiencies, and reduce costs.
Okay, a big reorganization.
Yeah. A big part of this is centralizing brand leadership into 4 distinct customer-focused groups.
Okay.
Core, milestone, and romantic gifting, which includes K and Peoples, style and trend, like Zales and Banter,
okay,
inspired luxury Jared and Diamonds Direct,
got it,
and their digital-first brands, Blue Nile, James Allen, Rocksbox.
Okay, so really separating out those brands by the customer that they're targeting.
Exactly. They're also centralizing key operational functions, like media, buying core merchandising and sourcing repair services, and their digital and IT infrastructure.
Right. So they're taking all of these things that they were probably doing separately for each of their brands or banners previously,
right,
and centralizing them to save on cost.
Yeah, exactly. Even their store operations are being realigned to this brand-specific structure, and they've reduced their senior leadership team by about 30%.
Wow, that's a lot.
Yeah, that sounds like a pretty major shakeup.
It does. It sounds like a very comprehensive restructuring, but, like we were saying before about centralizing those functions.
Yeah.
It should create some economies of scale. It should improve the coordination across the company. It should eliminate redundancies. And having all of those brands organized into those customer families, it just allows for a more focused approach to each market segment. And, anytime you shrink the C-suite, you're generally going to have faster decision-making. You're going to have a more agile organization.
More nimble. Yeah.
And, that can be a little disruptive in the short term, but the long-term benefits can be really significant.
Yeah, absolutely. Let's dive into a core part of their business. Diamonds.
Okay.
Their diamond category strategy seems quite deliberate. They're clearly committed to maintaining the prestige and desirability of natural diamonds, particularly in the crucial engagement ring market.
Makes sense.
At the same time, they're aggressively pursuing the growth opportunities presented by lab-grown diamonds in the fashion jewelry space, where they're seeing attractive AURs and profit margins.
Interesting.
They're even carefully considering how their different brands should incorporate both natural and lab-grown diamonds in their assortments.
Okay.
And are collaborating with De Beers on marketing and traceability initiatives.
Wow. So working with De Beers on lab-grown diamonds.
Yeah.
That's interesting.
And they mentioned that lab-grown diamond fashion sales in their main brands are up a remarkable 60% so far this quarter.
Wow. That's a huge number.
Yeah, really boosting their fashion AUR and margins.
So it seems like they're really onto something with this lab-grown strategy.
Yeah, that's a staggering growth rate.
Yeah, absolutely.
So what do you think about this strategy of, really trying to keep those natural diamonds prestigious, but also acknowledging this huge growth in lab grown?
I think it's a smart move. I mean, they're clearly acknowledging that, those natural diamonds have a certain emotional connection to them.
Especially for engagement rings.
Exactly. People are still going to want that.
Right.
But, the value proposition of lab-grown diamonds is, it's undeniable.
It's hard to argue with.
And the fact that they're seeing 60% growth in that segment,
right?
I mean, that really suggests that there is a strong consumer appetite for that.
Definitely.
I think the collaboration with De Beers is really interesting because, they're historically associated with natural diamonds.
Right.
But the fact that they're, working with Signet on the lab-grown side, I think really speaks to, a potential shift in the industry.
Yeah, it does.
And, it could help build some credibility and transparency in that lab-grown diamond segment.
Yeah, that's a good point. On the sourcing front, they're aiming for greater efficiency and better pricing by centralizing their sourcing practices across all their brands.
Okay.
They also highlighted their existing relationship with De Beers as a site holder.
Right.
Which gives them direct access to a supply of natural diamonds.
Yeah, that's a big deal. And, centralized sourcing is just a very common strategy for large retailers to, leverage their size and get better terms.
Exactly. Real estate is another area where they're making significant moves with a four-pronged real estate optimization plan. This includes a strategic program of closing underperforming stores.
Okay.
They're evaluating about 150 over the next 2 years.
Right.
They're also focused on maximizing the transfer of sales from those closed locations to nearby stores or online.
Okay.
A significant part of the plan is repositioning nearly 200 stores currently located in declining malls to more promising off-mall locations.
Hard.
Over the next 2 to 3 years. And finally, they're investing in their existing high-performing stores with around 200 renovations planned for this year alone.
Wow, that's a lot of renovations.
It is, yeah. They anticipate these actions will collectively boost their store-level profitability by roughly 1 percentage point and reduce their reliance on North American mall traffic to under 30% of their revenue within 3 years.
Okay.
That's a pretty ambitious undertaking.
It is, but I think, given the current environment and, the decline in mall traffic in many areas, it's very necessary. And it's forward thinking to be addressing this proactively. So it seems like they're really doing everything they can to make sure that they're in the right locations and that those locations are optimized.
Exactly.
And, those renovations to the high performing stores.
Yeah.
That's a sign of commitment to keeping those stores fresh.
Yeah.
And keeping the customers happy.
Exactly. And that 1% margin improvement at the store level, that can have a huge impact.
Yeah. That flows right to the bottom line.
Absolutely.
Yeah.
All right. Turning to their financial outlook for the first quarter of fiscal year 2026, they're currently seeing positive comparable store sales performing at the higher end of their initial 0% to plus 2% guidance range.
Okay, so doing well so far.
Yeah. They expect total sales to be between $1.5 billion and $1.53 billion, with adjusted operating income in the range of $48 million to $60 million. Looking at the full fiscal year 2026, they're forecasting total sales of $6.3 billion to $6.8 billion, with same-store sales potentially ranging from a decrease of 2.5% to an increase of 1.5%.
Okay, so pretty wide range there.
Yeah. They're anticipating a moderate improvement in their gross merchandise margin, but SG&A as a percentage of sales might be slightly higher, especially at the upper end of their sales guidance.
Okay.
They expect their reorganization efforts to generate $50 to $60 million in cost savings this year.
Right.
With an annualized impact of at least $100 million.
Okay, so those cost savings starting to come through.
Exactly. Their adjusted operating income for the full year is projected to be between $420 million and $510 million, with capital expenditures remaining relatively flat at $145 to $160 million.
All right.
Their EPS is expected to be in the range of $7.31 to $9.10, which is being impacted by a roughly 6 percentage point non-cash increase in their tax rate.
Okay, so that's important for investors to keep in mind because that's not actually impacting their cash flow.
Exactly.
It's just an accounting thing.
Yeah. And they also mentioned they plan to continue opportunistic share repurchases.
Okay, so they're going to keep buying back those shares if it makes sense.
Exactly. So a lot of moving parts there in terms of the guidance.
Yeah, I mean, it seems like they're optimistic based on the early results for Q1.
Right.
But they're also being a little bit cautious given, the uncertainty in the economy.
Absolutely.
I think those cost savings from the restructuring are going to be really important to offsetting any potential headwinds.
For sure. Finally, regarding the engagement ring market, they anticipate it will be relatively stable with market level growth in the low single digits, either positive or negative. Their own guidance assumes a slight decrease to flat in their bridal AUR. They expect their unit sales in fashion jewelry to be flat, but the average selling price in that category is projected to rise due to the increasing incorporation of lab-grown diamonds. And their stated goal is to gain market share in the engagement category as it recovers.
So they're not expecting huge growth in the engagement ring market.
Yeah.
But they are going to try and gain some market share.
Yeah.
And it sounds like they're continuing with that strategy of trying to boost the fashion AUR through the lab-grown diamond.
Exactly. So for you, the listener, what are the key takeaways here?
Yeah.
It seems like Signet is making some significant strategic bets on the power of individual brands, the growth of the fashion jewelry market, particularly lab-grown diamonds, and a more streamlined and efficient operating model. They're also proactively addressing their physical footprint in a changing retail world and demonstrating a commitment to returning capital to shareholders.
I think that's a good summary. I think that, the move to a brand-centric approach, coupled with their focus on these high-growth areas like lab-grown diamonds and, self-purchase and gifting, that could really drive some long-term value if they can execute on it.
Yeah, and their focus on optimizing their real estate.
Yeah, absolutely.
Is really addressing a critical need in the current retail environment.
And, they're clearly focused on cutting costs.
Yeah.
And becoming more efficient.
Yeah.
Which should help them, weather any potential storms.
Absolutely. All right, now for our This Is Not Financial Advice segment, where we delve into some unconventional, yet potentially plausible trade ideas.
This is where we have some fun.
Exactly. So imagine you're a hedge fund analyst presenting a pitch to the investment committee.
Oh, God. I love it. I love it.
All right. So based on everything we've discussed today, what's your pitch?
Okay. So here's an idea for you.
Hey.
Consider Signet's very clear and aggressive push into the lab-grown diamond fashion jewelry segment.
Right.
Highlighted by that impressive 60% growth we discussed.
Yeah.
And also, considering that intriguing collaboration with De Beers, traditionally a giant in natural diamonds.
Right.
Why don't we establish a long position in Signet?
Okay.
But as a contrarian hedge, simultaneously take a small short position in a publicly traded company that is exclusively focused on natural diamond mining and exploration.
Interesting. Okay, so walk me through the logic here.
So the idea is that the increasing consumer acceptance and the attractive profit margins associated with lab-grown diamonds in the fashion space, even with potential future price compression,
Right.
could disproportionately benefit a large, diversified player like Signet.
Yeah, makes sense.
They can cater to both natural and lab-grown preferences
Right.
and leverage their existing scale and brand recognition.
Right.
Conversely, companies solely focused on extracting natural diamonds might face some headwinds if the demand and pricing power for natural diamonds outside of that core engagement market weakens as lab-grown alternatives become more popular.
Yeah, that's a good point.
And the fact that even De Beers, a name synonymous with natural diamonds,
Right.
is collaborating with Signet in the lab-grown arena further suggests that there could be a potential long-term shift in the market dynamics.
Yeah, that's an interesting point.
Yeah.
So it's not a bet against natural diamonds entirely,
No,
especially
no.
for engagements,
Right.
but rather a wager on Signet's adaptability and the potential disruption in the broader fashion jewelry market.
Exactly. And remember, this is a highly speculative idea
Right.
and not financial advice. Conduct your own thorough due diligence.
Absolutely. All right, that was our in-depth exploration of the Signet Jewelers Q4 FY25 earnings call.
Yeah, a lot going on.
Yeah, a lot to unpack there, but we hope this deep dive has provided you with some valuable insights into their performance and future strategies.
Yeah, we tried to pull out, the key points.
For sure.
Yeah.
Now, what are your thoughts on all of this?
Yeah.
What are your thoughts on Signet's brand-focused strategy?
Yeah.
And how significant do you believe the rise of lab-grown diamonds will be in reshaping the jewelry landscape?
Yeah, these are crucial questions to ponder.
Absolutely. And remember, this has just been a focused look at the key highlights.
Yeah, there's a lot more to dive into.
So for more detailed analysis and to stay informed on future earnings calls, keep listening to The Deep Dive.
Yeah, we're going to be here every week diving deep into these complex reports for you.
And we're always interested in your feedback and suggestions for future deep dives.
Yeah, let us know what companies or sectors you'd like us to cover next.
Absolutely. And as always, nothing discussed on The Deep Dive should be taken as financial advice.
Yeah, please do your own research.
Always remember to do your own comprehensive research before making any investment decisions.
See you next time.
Take care.